The market's in crisis mode right now. Here's what's happening. People are fearful that 1960s style inflation is back. In case you're not familiar with that, here's a very quick primer. When the Korean War ended in the early 1950s and Korean War-related spending came to a halt, we saw war-related inflation, which wars lead to shortages and spikes in prices. Remember, guns and butter, and this is the original definition of guns and butter, not the definition of guns and butter that we use when we talk in stocks and psychology of money, because we've redefined it to something that relates to us on a daily basis. Obviously, those of you in the programs know. More importantly, though, back in the early 1950s, you did have inflation because it was wartime. Wartime shortages leads to temporary inflation. Great. That temporary inflation proved to be temporary, and inflation levels fell to low levels that we've actually seen over the last decade now. We have seen inflation bouncing around 1.3, 1.4, 1.5%. Guess what inflation was bouncing around between 1951 and about 1965? 1.2, 1.3, 1.4, 1.5%. You had very, very, very low inflation during the post-war sort of boom in the 50s to the mid-60s. Now, unfortunately, starting in the mid-60s, we started having a lot of social spending, which sounds very, very similar to the COVID relief packages, followed by this $4 trillion Biden infrastructure plan. Now, initially, economists have said, well, wait a minute. In the 1960s, like in 1965, we had wage price controls. We had just regular price controls. So we had price controls on general prices and price or limits on wages. And so it was sort of as a way in the 60s, the mid 60s, of actually caging inflation. Like literally, think about J-POW going, we're literally just going to make it so prices can't go up, which makes shortages even worse, and eventually the free market takes over and breaks out of the cage. Well, that's what happened starting in 1967 to 1968. These artificial price limits, which right now we don't have. We don't have price limits. We have supply chain constraints, which are pushing prices up. But prices are free to go up. They're going up. Look at lumber. Look at wheat. Look at coffee. Look at meat. It's all going up. And they fluctuate, obviously, in the short term, but commodities are through the roof. Prices are through the roof. Wages are going up. Bank of America just yesterday talked about how now their minimum pay is going to be $25 an hour because they can't attract workers anymore. McDonald's is paying people $50 just to show up for an interview. Some McDonald's are paying people $18 an hour, apparently. It's nuts. And so economists initially said, look, the 2020 recovery is different from 1965 because this time is different. Never heard that one before. Because the COVID spending was one time. In 1965, we had this recurring spend. At the same time, in the mid-1960s, late 1960s, you had a Federal Reserve that was really nonchalant about everything. They're like, yeah, we don't need to do anything. Like literally, that was their attitude. Now you have a very different Fed. You have a Fed that's, we're prepared to act if we need to. We got the tools, aka interest rates are going to go up. We'll act if we need to. You got the market expecting that the Fed is going to act and raise rates sooner than expected. You do still have Federal Reserve Chairman Jerome Powell kind of doing the, look, I've been telling y'all I want 2% inflation. Now we're starting to see inflation and you're freaking out. This is what I want. So you have a little bit of some differences here. So it's, what do they say? It's not exactly the same, but history tends to rhyme. Doesn't necessarily repeat itself, but it can rhyme. Anyway, so late 1960s, 67, 68, you start getting this inflation because wage and price controls, limits on prices going up, start getting removed. And so this leads inflation to start going up, 4, 5, 6, 7% going into the 70s. Then, at the same time as you start seeing these inflationary pressures, we decide, let's just leave the gold standard and literally make our dollar backed by nothing. But the belief, which is what it is now, our money is just backed by the belief that it has value. So anyway, that obviously led to the hyperinflation that we saw in the 70s, which was, 10 to 15% inflation, interest rates, 10, 15% ranges, mortgages, double digits, which led to, what year was it? Volcker's Saturday night. Volcker's Saturday night. Volcker's Saturday night was 1979. Volcker's Saturday night was his anti-inflation movement. Really, really big day in history, where basically you had this decade of now inflation from like 70 or 67, where it started, to 79. And Volcker's like, that's it. We're going to go through the bloody disastrous pull down that we need to do, which turns into the Ray Dalio style great deleveraging, where you get a painful crash in markets. People get rid of debt. One of the reasons I've been talking about deleveraging for the last 6 months on this channel, and nobody wanted to hear it. This is also why I'm like, I'm going to get rid of my margin and I'm going to buy long options, not because those options can't go down 99%, but because at least they'll still have value left over when the market recovers. Whereas margin, you get liquidated on a margin call, you don't. You got nothing left. It's just gone. That's the danger of margin versus options. A lot of margin, obviously. But anyway, so now Volcker raises interest rates substantially. You get a sell-off. You get a deleveraging, which is stuff that we have been warned about. Ray Dalio's been talking about this great deleveraging coming, that maybe the 2020s are going to be more like a decade of deleveraging, where people are like, that's it. I don't want debt anymore. I want to pay down debt. Maybe you get what I've been calling a frugal decade happening, where people, we get this initial surge in spending, people going back to Disney, people traveling again or whatever. And then you get folks deciding, you know what, I'm good spending. I'm just going to focus on my financial house. I don't want to spend as much as I'm used to spending. And then really what happens is this fear of that sort of 1960s, 1970s style progress is leading to a lot of shorts in the market. We've seen shorting in the market go parabolic in the last 2-3 months. And it's because it's been very, very profitable. Anybody shorting tech and certain consumer discretionaries, especially online, has been very, very profitable over the last 3 months. The shorts are winning. And the shorts really started by hedging their long positions. You're long on Tesla, you hedge with shorts. You make lots of money on the shorts, maybe you hedge a little more. And then that spreads like wildfire through the hedging and shorting and weenie baby community. And they're winning right now. Fairness, the weenie baby shorters are winning right now. So you get the lever or the shorts winning. Then we've been talking about this. We look at the crypto market. What has not sold off yet? Because when short sellers make money, when they make a lot of money shorting the market in one area of the market, what do they want to do, folks? They want to make more money. So they start looking around going, well, what else can we short? Oh, Ethereum doubles in 30 days? Oh, that sounds a little juicy. Bitcoin up, what, $40,000-$50,000 in the last 6 months? Seriously, that's simple. Institutions can short crypto. We don't have easy access to shorting crypto. So the institutions who make up the majority of crypto traders now, they've replaced us retail traders, can set up all their shorts and watch all of us get squeezed out of the market, especially if you've taken on leverage, which now we're seeing mass liquidations, $4 billion of liquidations within the last hour, $8 billion worth of liquidations in the last 12 hours, are reports we're seeing. Coinbase is shut down. Well, at least partially. Halting Ethereum withdrawals. You got Binance saying leveraged tokens, redemptions for leveraged tokens are not available. So you got crazy liquidations happening. You got Coinbase, BlockFi, and Binance all down to some degree, which is very reminiscent of the concerns that we've been talking about on this channel, that what happens if we have here we go. Kraken says Ethereum and ERC20 token deposits and withdrawals are currently delayed. You can't take your money out. You just can't take your money out. This was the big fear we've been talking about on this channel. And this, I'm worried this is, I want it to end, okay? Like, don't get me wrong. I do not want to see this crypto nightmare continue, because all it does is hurt the retail folks who are just getting started with investing. It's not like my interest in buying the dip is not greater than my love for people not getting screwed. Like, I don't want to see people getting screwed. And margin is screwing people here. This is why we're seeing these liquidations. But the problem is, it's not just people's margins. It's how much leverage is in the crypto system. I don't know. I mean, so far, we're stable. Okay, like, let's look at the sticks. So far, we have fallen to the levels that we thought things might fall to. We briefly fell lower, but we're in that low 2000s range in Ethereum. These were where we've had longer term supports. Bitcoin has had longer support between 32 and 34. It's actually bouncing around 35. So it's doing a little better than expected, at least where it's bouncing right now. And it's bouncing around that 35,000 right now. Doge does have a support line. I didn't just draw that line today. That line has been there for a very long period of time. Doge has had this, support around, and this rubber bands around here. We got another update here from Coinbase. Intermittent downtime on Coinbase platform. We're currently investigating the issue, trying to implement fixes. But anyway, crypto, the next levels of support, I don't even know that I want to look at them. We'll do it. But folks, this is tough. I mean, look at this. For Doge, I mean, low 20s is the low to mid 20s is the next level of support for Doge, if we get a continued sell-off. And then after that, I don't even want to talk about that, because literally, if we break through the low to mid 20s, folks, there's nothing between the low to mid 20s and 5 cents. Nothing. And even 5 cents didn't last that long. Ethereum, red candle sticking, obviously, this is on the day chart here. So this is what we were talking about, prior longer term supports right here. But if we fall past this, if we start breaking 21 consistently, I don't know, what do we got? If I could get a week, that'd be nice. I don't think I can, though. Yeah, okay. Yeah, 1900, maybe a temporary shelf around that 1400 level, maybe. And I don't want to go past that. Bitcoin, and I don't think we need to. I mean, this was good. Otherwise we did have a little bit of a shelf here at 1819. I don't see that happening. The only way this happens, in my opinion, okay, the only way we go to 18,000 Bitcoin, and just don't trade off this advice, okay? Like, you lose money, it's your problem. It's not my fault. But just my uneducated opinion here is, but the only way we go to Ethereum 1,300, Bitcoin 18, 19,000, is if we get this continued platform unavailable crap at all the different crypto platforms. All of a sudden, you get more and more leverage fears of, oh my gosh, maybe the system is over leveraged. More and more people dumping, leading to more and more liquidations. That is, the over leverage in the system is the big concern. At the same time, anything crypto related is selling off dramatically. Dramatic sell downs in anything crypto related. Marathon, Big Digital, Riot, Voyager, Hut 8, all these guys down 10, 12%. AMC, momentum stocks down 10% here on AMC. Coinbase down 9.4%. Very Good Food Company down 7.5%. Wow. QuantumScape down 5.4. Tesla's down 420%, like 4.2%. Square is down at 195. A lot of pain, not a lot of green. Only thing really doing well today is Enphase, SolarEdge, and Target. Otherwise, you're either flat or you're losing today. It's pretty rough, and it's all coming off these leverage fears, great deleveraging fears, and inflation fears. So that's a summary as to what's happening in the market right now. A lot relating to those 60s to 70s fears, especially with Fed President Bullard coming out this morning. Literally this morning, he goes, "Don't worry, we will act if necessary," in response to the madness that's happening. I think Jerome Powell is sitting there with a cigar right now going, "Folks, I've been telling you for a long time 2% inflation was coming. Now you're freaking out. We might be seeing 2% inflation." You know, like that's like, I feel like Jerome's like, you know, got somebody fiddling right now. You know, like I told you this was coming. but to him, it's all according to plan. That this is just going to be a temporary, a lot of pain until we actually adjust to getting 2% inflation. I don't know, folks. We'll keep tabs on what's going on, but this is the summary of what's happening in the market. If you want to join me in the private live streams, we will be going live in the private live streams. I might, honestly, if this madness continues, we might even do a couple private live streams today. I don't know. We'll see. But if you want my perspectives in private, you want to ask questions, do consider checking out the Stocks and Psychology of Money group, a link down below. You can check out the other courses as well. You get the live stream access as well. So if you prefer real estate investing, whatever, use that coupon code expiring soon. Link down below, probably Friday. Thank you so very much for being here, folks. We will see you in the next one.